the confidence crisis hasn't occurred, right? When it occurs today, with the ease of transferring money in and out of banks, which, although it's not as easy as Bitcoin, still a lot easier than it would have been 20 or 30 years ago, well, then you can get a de facto run on the bank. And if your assets are in a serious mismatch, then you have a problem.
Our next guest is Lars Christensen, founder and chairman of the Concordium Foundation, a layer one science-backed blockchain. Lars is also a pioneer in FX and derivatives trading, having co-founded Saxo Bank in 1992, of which he was co-CEO for more than 20 years. Saxo Bank, headquartered in Denmark, is currently one of the world's most recognized multi-asset trading platforms, operating in 170 countries with over $100 billion in client assets. We'll be discussing what's next for the banking sector following the regional banking crisis in the U.S., institutional adoption for crypto and blockchain, and the most prominent emerging technologies for investors today. Lars, welcome to the David Lind Report. An honor to host you today.
Thank you very much for having me.
Very honored to be hosting you today. Let's talk first about your transition from the traditional financial world into DeFi. I'm always curious to get people's stories because it is a very interesting transition.
Yeah, I mean, you mentioned Saxo Bank, which was a very early adopter of the internet back in the mid-90s, and we built one of the world's first trading platforms online at the time. But apart from focusing a lot of that on that at the time, I also sat back then with this feeling that the internet was a truly transformative technology that obviously could do things for finance, but also for nearly any other industry. And but it's hard to believe today, but in those days, actually, there are a lot of people very skeptical of the internet. Was it a fad? Was it going to go away? Nobody uses it. It's difficult to understand. And then some of us said, well, but we like it, and we're going to see what we can make on it. And I have a little bit the same feeling with blockchain today. It's also a potentially very transformative technology. It's quite clear that it can be used in many different industries, including the traditional finance industry, obviously, but in a lot of industries, basically anywhere where you deal with data and you want to make it more secure, you want to structure it better, you want to be able to link data completely securely with where it comes from, etc. So I'm sitting a little bit with a sort of a parallel feeling to what we had back then, that there's a lot of opportunities in this technology. It makes a lot of sense. It's very hard to point directly to what is going to be the big winner here, but it just has so much potential. And in that sense, I'm kind of reliving my internet history a little bit. So I don't think the transition is that big. And of course, there are a lot of opportunities also for DeFi and things that could improve the way we did things over the last decades in the financial sector. So I think it's sort of a natural progression, and blockchain kind of delivers the one thing that the internet never really did. The certainty of who you're dealing with, what you're dealing with, who owns what, that's kind of missing in the online, in the internet-based online space, because there's a lot of ways to do fraudulent things, to sell stuff you don't own, to sell it more than once, to have a lot of unclarity about what you're dealing with. And I actually think blockchain solves that last piece of the puzzle for the internet.
I'd like to ask you about the banking sector right now in the U.S. Certainly you're aware of the regional banking crisis that transpired over the last couple of months, with many banks failing, some being bought out. Do you think that maybe Dodd-Frank was not harsh enough or stringent enough for protecting consumers? Do you think there needs to be an overhaul of regulations yet again?
Well, I think some of the banks mentioned have played very much on the fact that they take short-term deposits, they put them into long-term papers. They don't have to mark those papers to market, so they can actually run with a loss that they don't need to account for in their books, which is very unhealthy, I would say. Because if you take a short-term deposit and put it into a 30-year T-bill and that C-bond, and that bond then drops 20%, which is what happened when interest rate turned, clearly you're sitting on a very unsustainable position. But because of the rule set that across many jurisdictions in the world allow you not to calculate that, because you actually calculate the value of the bond at expiry, gives a skewed view of what is the real risk in such a portfolio. Now, that perhaps would be okay if it was a little more difficult for people to react. But when we see this becoming clear to people and they then withdraw substantial parts of their short-term deposits in a very short period of time, and the bank has difficulty realizing the assets that it has at the value that it's sort of theoretically at, then you have the problem. And to be honest, you have that problem in a number of other banks, but where the sort of the confidence crisis hasn't occurred, right? When it occurs today, with the ease of transferring money in and out of banks, which, although it's not as easy as Bitcoin, still a lot easier than it would have been 20 or 30 years ago, well, then you can get a de facto run on the bank. And if your assets are in a serious mismatch, then you have a problem.
What was the motivation behind investing in long-term duration bonds? Were they looking for higher yields?
Yeah, and I mean, it's always easy to be smart after the event, but to take short-term deposits and then try to capture slightly higher yield in a asset that clearly would have a lot of downside if you got significantly raising interest rates, didn't maybe seemed a good idea at the time to some, but it certainly doesn't seem like a good idea today. And I think if you have long-term assets that are very, very exposed to increases in interest rates, then that's a very dangerous game to play. But a lot of people have played it, and obviously sovereign states also have an interest in people buying their bonds. So there is kind of a little bit unhealthy synergy there, which is probably also why the rules are as they are. But that can't help you if you get a bank run and people want their money here and now. Then you can't sit and wait for a 20 or 30-year bond to expire, right?
But there were no regulations against taking deposits and putting that money in anything besides just cash and not putting it in any other financial instruments. I mean, part of the problem with, let's take FTX, for example, was that they were commingling funds. Now, I'm not saying that the traditional banks, the regional banks in the U.S. were commingling client money, but it certainly seemed that they were putting deposits into an asset that turned out to be not very safe for their books, at least. There was no regulation against that.
Well, that's banking, right? I mean, in effect, when you put cash into a bank, it goes onto the bank's balance sheet, and it is for the bank to make the investments or the lending against that as they please, by and large, right? That's why sometimes if you're not comfortable with a banking counterpart, you could yourself buy like 3 months' bills or something, and they would be treated completely different in case of a default where they actually belong to you. But when you hand your cash over to the bank, for a period of time, it belongs to the bank. So I don't think the banks necessarily did anything incorrect here, but that is the nature of you putting cash on a bank's balance sheet, and you do that because you expect it to lend it out and generate a margin on that. But maybe you didn't expect it to go and buy bucket loads of a asset with a lot of downside if you got what sooner or later, in my view, had to happen. But of course, interest rates couldn't be sustained at flat or negative levels as we've seen here in Europe forever. I mean, that just could not be the assumption. It stayed there longer than most people, including myself, would have thought that they would, but ultimately things tend to sort of revert to normality. That being said, certainly since the last financial crisis back in 2008, there's been a number of rules sets about the amount of liquidity that a bank needs to maintain. So there are actually a number of regulations that secures that banks maintain a relatively high amount of liquidity to meet bank runs. But if a bank run affects 30, 40, 50% of your balance sheet, then it begins to get quite tricky, right? The problem with FTX is something completely different, in my view. That was perhaps commingling things that shouldn't have been commingled, but as there were no real regulations telling them what to do or not, you're more dependent on their common sense, and obviously they didn't possess an awful lot of that. And again, there was a lot of speculations in different assets and a lot of commingling with other institutions that absolutely could not have happened without being illegal in the traditional finance sector, and hence, therefore, typically wouldn't happen. But I think it still remains to be seen exactly how big a mess FTX was. But sort of from hearsay it was a very limited risk management function and a very limited understanding of the risks that were assumed. Whether that was in bad faith or just pure ignorance and naivety, I wouldn't want to be the judge over that, but it's clearly something that would have raised a lot of eyebrows if it happened inside a regulated bank.
You brought up interest rates. I want to ask you real quick, how do European banks make money during the period of negative interest rates? Because presumably if you were to deposit money in a bank and you have negative interest rates, I have no incentive to deposit money in a bank.
But again, what are your alternatives, right? So a lot of money were deposited into negative interest rates also because there were not really an alternative. Even if you bought a 12-month German bill, you still have negative interest on that, and not much different from a cash deposit, right? So people still have to place their money somewhere. But of course, that led also to a number of spurious asset bubbles because people think like that, well, if I'm going to get negative interest, let me rather invest in an asset that I think could be more attractive. But that obviously has led to a number of bubbles that we're sort of seeing working off in the general markets, not least in the tech industry. There's been a lot of working off that bubble. So that also leads to unfortunate or let's say risky behavior if interest rates are very low or even negative, because who wants to sit and see their $100,000 being $99,000 a year later, right? That is kind of triggering people's interest in going out and trying something else. But that then create new risks of asset bubbles, and I think we've seen a few of them, and probably also benefited crypto at one point, right?
Yeah, depositors certainly had it tough. Either you were in a negative interest rate environment or you were in an environment with higher inflation and the value of your deposits would have been eroded over time anyway. We saw in the DeFi sector several asset management firms within crypto companies. I don't want to name specific names, but we saw the emergence of yield products that were outcompeting traditional financial banks. Some yield products offering high single-digit APYs, for example, and the sell here was that traditional financial banks could not keep up. What is your response to this business model? And do you think that banks should eventually start competing with some of these other yield products that are offered in the crypto space?
Well, I think a lot of them were very creative, to say the least, where the real value was paid in a token that maybe had a value, and people then tried to support this, that, and the other way. You should generally be very careful if somebody promises you over normal returns, because where are those returns going to come from? They're going to come from either a very high degree of risk of something going wrong, or they're gonna come from some people that will eventually not think it's so great that they're paying the bill. I mean, even in crypto, money doesn't appear out of nothing, right? You have a valuation of various assets that can go up and down. People once thought that a Bitcoin was worth $1, even a cent, even less than that, and now they think it's worth $30,000, right? At one point, they thought it was worth $66,000 2 years ago, right? At the beginning of the year, they thought it was worth $16,000. That's like any other assets driven on demand and supply, right? So that's one thing, and most people, I think, understand the risks that they take. But if you have a sort of a yield farming project where you're being paid in an odd token, or I think a lot of those models were over creative. But of course, again, a result of having no regulation, having very few experienced people in the market, and perhaps investors that generally believe that some of these things were different or are different. And I can just only say, if you don't understand it and it's over normal returns, you got to be very careful always. And that doesn't matter if you're in crypto or in traditional finance or in any other market, really. It's a warning signal, and you just got to be very careful.
So looking forward now, how do you think the traditional banking sector will evolve on a very high level? On the one hand, you had the regional banking crisis that brought to light several risks that perhaps some banks took that we discussed previously. We have the crypto space that's developing banking products that some might say are competitive. And of course, we have other tech companies offering banking solutions too. A month or two ago, Apple in partnership with Goldman Sachs, launched a banking solution to some of their customers. This is a very interesting development. So how is the traditional financial institutions, how are they going to develop, evolve, and compete?
I think that a lot of the things that you see coming from non-financial sector participants are typically very narrow products. You know, it's a savings account, or it's a transfer money account to your kids when they need something. You know, a full-fledged bank offers a whole range of more things, but that doesn't mean that some of their very simple and often highly profitable products couldn't be sort of taken by people focusing on one or two of these products. But I think that's what you generally see, right? And then you have a lot of these neobanks that only measure their success in how many new customers do we get, because at least for a period, you had some VCs and some investors that are willing to fund that specific KPI, if you will, right? Now, the secret is actually that the bank were not too unhappy to see some of these clients go, because these were unprofitable clients that they kind of have an obligation to maintain a bank account for in many countries, right? A bank actually in many European countries have the obligation to offer a bank account to somebody if they need one, right? But those bank accounts are typically not very profitable, if at all, and they were actually not too unhappy to see some of the neobanks desperately picking up anything just to show account growth. So, and that's also why the vast majority of neobanks have been dependent on continuous, very large funding rounds to just stay afloat, while actually some of their metrics look pretty good in terms of more users, more accounts, and this and that. But you know, it's not that difficult to get a lot of accounts if you're willing to lose money on every single one of them, right? I mean, if you want to pay over normal interest rates, it's nice for the customer, but it's not very nice if you can't actually make money on a client. And hence, I take a pretty skeptical view of most neobanks, because I think they're typically going for soft targets where you can onboard them if you're willing to assume a cost. They are actually often gladly onboarded by the traditional financial players because they have a profitability aspect to look at. And secondly, they're typically very loyal to the bank, you know, where, you know, this neobank gave me a couple of % above market rates. Now they actually want to try to monetize, so they lower it. But now there's a new neobank over there that wants to show account growth, and I'll just shift to him. The thing about the traditional banks and their traditional client sectors is that they're actually quite inelastic. They don't move a lot, you know, and you can agree with it and you can think it's deserved or not, but actually client bases are quite loyal to their banks in practical terms. They might like to talk really bad about them, and they might like to have all sorts of views on them, but for people to actually transfer their traditional bank account from bank A to B is pretty rare. To transfer it across borders is even more rare for, you know, a German customer to start using a French bank. Here I'm talking about the general public, right? So these guys are incumbent in a position where they have pretty inelastic client bases that don't move around just for a little thing. They don't necessarily deserve them. They don't necessarily treat them very well, but they stay there. And that's very different to some of these things where people move for a great offer, and then when that offer is removed, they move on to something else, right? And by themselves, in many of these banks, they're quite small customers, and hence very hard to actually ever make profitable, right? So there you have to take a speculation that they will grow over time, but that's a long and costly speculation to take for a neobank, right? So I think you should never, and I'm not here being apologist for the banks in any way. You know, I know better than most the shortcomings of the traditional banking system and seen it up close for many years. I know the sort of the ethics and the morals in that sector. So I'm not an apologist for these guys, but you should never underestimate the existing power a bank that has a large client base actually has. And if they really need to bring another product on, they will do it when they see that product as potentially being profitable for them. And then they can typically buy their way into a small player that can then provide it, right? So I know a lot of people in the crypto blockchain space are extremely skeptical of banks, but if you ask at a conference, so how many of you have got a bank account, you will see 95% of the hands rising, right? So that's just, you should estimate the sort of solidity of the positions of traditional banks. And they are no rush to do this because they need regulation in place to be able to act. But they will also have a view for things that can reduce their cost, make their processes more efficient. They won't be very good at executing. It'll take a long time, but they will, of course, be interested in anything that can reduce their settlement costs, their manual costs, etc. Are they going to be happily passing that on to the client? Well, I don't think so, but they'll certainly be happy to use anything that cut their own cost base, right?
What should be the priority of U.S. regulators? Take the SEC, for example, when it comes to governing cryptocurrencies right now.
I follow more of what's happening in Europe, for example, where we actually have brought out a broad framework called MiCA, right, Markets in Crypto Assets, and I actually think that's quite encouraging. You know, there's a lot of sensible things in that, and it's not about throwing the baby out with the bathwater. You know, we have a number of conversations with regulators and EU people that are preparing the laws, etc. They're actually very open-minded, listening. They see a benefit in some of the functions that blockchain have. So they I think have gone fairly systematically around it, and I think that MiCA, which will by far not be the last set of regulations, but it's not a bad start. Whereas I don't see quite that clarity in the US, but maybe something's going on behind the scenes at the SEC and the CFTC and the various people that are sort of claiming jurisdiction over it. But I think it would be really very sensible and also fair to the industry to try to provide a clear framework. Because if you speak to a Coinbase or people like that actually have tried to behave, in my view, overall, but they don't really have a framework within which to do it. I think you have to distinguish from an actor like Coinbase from FTX, which didn't try to behave and didn't have a regular framework and dramatically abused that, it looks like, whereas some players in the US actually are, as far as I can see from the outside, quite responsible and actually just trying to do the right thing, but find it very difficult to do the right thing because the regulation is not as clear as it is beginning to be in Europe and in places like Switzerland, Singapore, so making good progress on these things, right?
And if you were to recreate Saxo Bank today and integrate blockchain technology, would you do it if you had the option to?
I think timing is always important, and I'm happy that we did Saxo Bank when we did it, when we really could be sort of an innovator and on the cutting edge of a new technology. I think it'd be much harder to do a new Saxo Bank today, where that's kind of the broadly adopted way of doing trading. But absolutely, I think there is a space for integrating blockchain from sort of a greenfield operation and make many more processes based on blockchain. So yes, I'm sure that if I wanted to do another Saxo Bank, blockchain would play a big role in it. But I actually, in some ways, think that it's more interesting to go in and see how you can improve processes in existing contexts, and then maybe sit back and wait and see who shows up with the real deep innovations. Because just like the internet was obvious to improve some processes, but you couldn't really foresee the really big winners in the long run. I think it's a little bit the same here. It's evident that it can improve some processes, but I'm sure there'll be a lot of innovation in the space and some people coming up with the really big killer use cases for blockchain, right?
There is a wave of applications for spot ETF filings in the US. First it was BlackRock. Now today I'm seeing Fidelity is reportedly next. ARK may also be looking into it. Now, is there a use case for a spot ETF for Bitcoin in the institutional space?
I think there is, but I would also like to sort of, again, divide a little bit between the speculations in various crypto tokens, which is one thing. You know, you have a group of people that like to invest and speculate in various assets. And then we have the sort of more infrastructural part. How do you improve processes with blockchain, right? Now, a lot of people do like to invest or speculate in Bitcoin. And as we've seen multiple examples of, the venues for doing so are often unregulated. They are not subject to the same level of due diligence as we know from the traditional financial sector, and that has kept a lot of people out of that market. So I fully understand that some of the traditional players see an opportunity here. Could we provide a more secure way for people to get exposure to this new asset class? And could we do that through some of the tools and the mechanisms that we already know, such as an ETF? So I think for sure a lot of institutions will feel more comfortable if they want to have an exposure to Bitcoin. They will feel more comfortable doing that with a BlackRock ETF than they would downloading their own wallet, doing their own custody, going to unregulated marketplaces. In fact, they may be prevented from going to these marketplaces due to regulation. So yes, I think there's a space for the traditional sector providing a safer environment for trading in these instruments that is necessary for sort of bigger institutional adoption, no question. And I also think now where we've seen a couple of pretty disastrous experiments with unregulated exchanges, like most notably FTX, obviously, it's not surprising that some of the big players actually say, here's a gap that we can fill by providing a more solid infrastructure and provide more trustworthiness to people that want to get involved in it.
Now, if you were to look ahead and examine mass adoption for, let's just take Bitcoin, for example, would it come more from the institutional side or the retail side, do you think?
Well, so far it has largely been a retail play, of course, and the sort of institutional adoption is crypto institutions, and you have some investment funds that would invest in that, but not really the traditional hedge funds, the traditional institutions, right? I'm not a Bitcoin maximalist. I think it's an interesting experiment. It has obviously got some traction, but I actually think there's a lot of stuff out there that's a lot more interesting than Bitcoin in isolation. But of course, once you have an ecosystem and you have an investment interest and you have a group of people that want to get engaged, well, then that will typically be driven by some enthusiasts, by perhaps some private investors, and the bigger institution will only follow suit once there is an environment that they're comfortable interacting with and counterparts that they're comfortable interacting with. So I think that's a natural progression. I mean, Bitcoin doesn't really do very much. You can't really, like many other blockchains where you can execute smart contracts and do a lot of improvement of processes. That's not really Bitcoin. Bitcoin is very reliant on people agreeing that Bitcoin has a value. And if you do agree that and you think that's long-term sustainable, then of course it's a nice and efficient tool if you want to do transfers quickly and with immediate settlement compared to the traditional system. And I think, for example, in emerging markets, it may serve a purpose where you don't have the kind of normal infrastructure that we're used to. You have not very credible currencies. You have a big diaspora of people working outside the country that needs to transfer small amounts back to their families, etc. And there, I think Bitcoin, assuming that people generally agree that it has a value, provides a solution, right? Now, the question is Bitcoin really the new gold, or is it something that will have its time and then be surpassed by more efficient systems, right? But at the end of the day, it has been driven by, I think, some real use cases, particularly in emerging markets where it probably has been more speculation to a large extent in sort of our end of the world, right?
Well, can you explain this to me? So you are the founder of Saxo Bank, one of the largest investment banks in the world, and so you have experience setting up financial institutions. Why is it that people in emerging markets who are underbanked now are pursuing this avenue of using cryptocurrencies as a banking solution? I mean, presumably if they have the capital, wouldn't they just use a traditional financial institution?
Yeah, and they do that if they have the capital. I mean, there's a reason why large parts of the world is unbanked, and that's not actually like some conspiracy theorists think that's because the banks don't want to onboard them. That's because the cost of onboarding clients when you actually live up to various regulatory expectations is very high, right? And that means that very small investors or clients or savers are simply not economical for the traditional system because of all of the stuff that's around that in terms of obligations. And there you can say, at the cost of not being regulated and with all the risks that are implicit in that, then crypto has provided a much easier onboarding opportunity for such users, which realistically can't get bank accounts because the banks can't justify from an economic perspective to actually onboard them in a regulated environment. But it is, of course, a very double-edged sword, because that also means moving around for these already probably not very experienced investors to move around in a totally unregulated space where at least one leg of regulation is around making sure that people that are inexperienced or naive around financial markets have some kind of protection against abuse by people that know more about those markets, and that protection doesn't exist in crypto in that form, and hence there's a lot more risk factors for people engaging in it. But I would say primarily driven by countries like, let's say, Venezuela, Zimbabwe, where you can't trust the central bank, you can't trust the local currency, you have perhaps a lot of need for small microtransactions cross-border, and those would be near impossible to do in failing states like those, right? Because they simply don't have them, or they're only available to the elite of the country, right? That can actually have foreign bank accounts, etc., right? So in that sense, I do believe that crypto solves some real problems in some parts of the world. But it is, of course, at a cost of very little protection against people exploiting the users.
Right, and I guess also in countries with capital controls like Lebanon, where you're restricted in the amount of cash you can withdraw from your bank every day. So in that sense, yes, it's very helpful. Bringing it back to the G7 countries, is there a scenario you think that in the future traditional financial institutions will start to offer crypto currencies as financial products and solutions, either in lending or either in accepting deposits in cryptocurrencies?
I think so, because to tell you the truth, bankers will be there if there's a business model for them being there, right? And there seems to be enough traction in something like Bitcoin and a couple of other of the crypto, more well-known cryptos, that it represents a potentially lucrative business case, right? And that's where you will see traditional banks showing an interest, right? And at the same time, there's a lot of potential users that simply cannot really get comfortable with the way that you could otherwise trade it through unregulated exchanges, or they can't really motivate themselves to go through the rigmarole of downloading a wallet and understanding this and remembering their codes and keeping them safe, this, that, and the other. So I do believe that there is a market for financial institutions offering some of the bigger cryptos because they can kind of take care of all that noise around it, and people can simply have a part of their portfolio invested in a new asset class. And I would say, whether you're a big believer in the outlook for many cryptos or not, I would say to have a portfolio today where you didn't have a little bit of exposure to blockchain or a little bit of exposure to these new asset classes would be a little bit like saying, well, I have a portfolio, but I don't want any exposure to the internet 25 years ago, right? And that would have been a very unwise decision, as history has shown. And hence, I would say if you anyway want to have a diversified portfolio, I would say having 1% or 2% in a new potentially transformative technology would be nearly the responsible thing to do, but certainly a very obvious thing to do, because if this really takes off, well, it also has, I guess, the potential for over normal returns, and that's exactly, in my view, the same reason that you would want a little bit of internet exposure in your portfolios back in the day, right? So I see the requirement and the possible market for this, but I also see that very many of these potential buyers or investors would not be comfortable with the space as is. Hence, the big boys step in and provide probably not the most sophisticated or the cheapest or the best solution, but something that's understandable and that people see coming from institutions that they trust anyway with their salaries and their investment portfolios, right?
We talked about traditional financial banks potentially offering crypto product in the future. Let's do the reverse. So yes, you go to a conference, everyone raises their hands, everyone has a bank account. Well, that's because I need banking solutions that perhaps aren't offered by like Binance or Kraken, for example. If I want to get a mortgage, I don't go to a crypto exchange. I go to a traditional bank to get that done. So when are we going to see exchanges, crypto exchanges, or perhaps crypto asset management companies offer traditional financial products like loans, mortgages, car loans, etc.?
First of all, they will only, in my view, be able to do that with any kind of trustworthiness when there's a regulatory environment in place to support that, to give the confidence to people to actually use them. Secondly, there's a reason why these banks have the big balance sheets and tightly associated with various mortgage companies, etc., which is because you need a lot of capital to do these kind of services, right? This is a statistical game. A certain amount of people will default on their mortgages, a certain amount of people will default on their loans, and you need a very widespread portfolio to have a good statistical prediction of. You certainly want to make sure that you don't take all the easy wins, because all the people that couldn't get a mortgage in your traditional sector might well stream over to you if you offer one, but that might be the least attractive customers you could possibly imagine, and hence you'll see a much higher default rate than you have on the average, right? I don't think in general that the expertise is there in the DeFi space to offer real banking solutions. I more see a merge of the very smart people that are on the tech side for developing solutions, etc., merging a little bit with the fairly deep knowledge that they have at the big institutions of how financial markets really work and how much capital is required to actually make them work, right? Most of these, if you look at the total value locked, as you call it, TVL in DeFi, I mean, it's probably less than $100 billion at the moment. Now, $100 billion is a drop in the ocean for even a single large bank, right? So the size of this is very small to this day, and it doesn't actually show dramatic improvements, rather the opposite, because it was a couple of $100 billion a year and a half ago. So I more see the merge, and there's no question that the traditional banking sector can learn a lot from the stuff that the blockchain enthusiasts have developed, right? But there's, in my view, also no question that this industry, very, very young, very inexperienced industry, could learn a lot from people that actually know how the financial market work, right? And that I think is something we will see developing over multiple years, that these things merge more and more as the regulatory environments will begin to look more and more alike. And this will, in my view, only be a question of time. It's not an if that you're going to have regulation that looks a lot like the trad sector. It's only a question of when.
I understand. Tell us a bit about the Concordium Foundation and the blockchain that you're working on. It's a layer one. It's based on a philosophy of privacy. Tell us more.
Well, it's first and foremost based on a philosophy that kind of encompasses the stuff we talked about here, right? I believe there's going to have to be some kind of merge between the old world, if you want to call it that, traditional models, and this new technology. I think that is a precondition for mass adoption, for mainstream adoption. And then there will be a lot of smart things once all those building blocks are in place, that I can know with certainty that you are David and you own an asset that you want to change to me. You can know with certainty that I'm Lars and that I have accountability. When we have that trust between each other, I think a lot of models can be built inside what regulation will allow, right? But I really think that we built Concordium with the view of taking all of the best from the decentralized space. And I think there's a lot of things that you avoid with a well-designed blockchain in terms of risk of single points of failures, etc., data manipulation. But there's also a world around it that will want to impose itself on this industry. And one of the absolute basic building blocks of all regulation, all KYC, all understanding your client is, of course, that you know who you're dealing with. And for me, the anonymity implicit in the early blockchains is just a complete hurdle to mainstream adoption. So we actually, as a most key differentiating factor, we have an ID layer at the foundation, not as an afterthought on a layer 2, but in order to access the platform, meaning that people have been willing to identify themselves and hence have the ability to identify to each other. Now, when you have that, you can also allow actually more privacy, because you know that people can identify themselves and you can then know what you're dealing with. So I think that allows you to actually bring in more privacy than you have on a traditional, like an Ethereum or a Bitcoin, where you have anonymous counterparts but total transparency, which would be the equivalent of saying, you know, we can see your bank account, but we don't know who owns it, right? In effect, in the real world, it's the opposite. The bank has a responsibility to know that there's a real person and what the background of that person is to have a bank account, but they don't put the bank account on the internet, right? So for all to see. So I think the balance of accountability, anonymity, transparency is completely flipped in the original generations, whereas what you really want is people being in a position to hold each other accountable for their actions, but then allow them some privacy around what they're actually doing that is completely reasonable to expect, right? So I kind of think that the industry got it wrong, at least if maybe they never assumed that they wanted mainstream adoption. Maybe it was built for a different purpose. But if you do want mainstream adoption, I think you got to play by the rules that the mainstream generally tend to impose. And I think regulation in crypto might look technically somewhat different from TradFi, but the outcomes that people are looking for, which would be protection of retail, protection of weak counterparts, KYC to prevent criminal activity and financing, AML issues. And then, of course, the sort of third big leg is capital. If you get it wrong, do you have the money to pay for your mistakes, right? And it's not that it always works in TradFi. We just seen a couple of examples that you had to earlier, but that's going to be the desire that any regulator, those are the desired outcomes that is wanted. And I don't believe they're going to be different for crypto to other regulated markets. It's only a question of time.
Mm-hmm. Finally, you are also a venture capitalist, and you've invested in several different industries in the seed rounds. Now, tell us about an emerging technology that you think has a lot of investment potential right now over the next decade or so.
Well, I'm not going to mention the obvious one that everybody's talking about right now. You know,
yes, besides the obvious one. Yeah.
That's obviously where the money is flowing right now, because some of this money is very sort of fickle and goes where the wind blows, right? But I actually think it's quite justified. AI is a major transformative technology.
Does that give you sort of pause though? Like if a project were to come to you and say we're an AI project, do you automatically think that you have to screen for that company a little bit more just because it is kind of the zeitgeist, everyone's jumping on it? And perhaps valuations are overstretched.
I'm old enough to remember that if you had a completely stupid idea or a failing business and you put .com at the back of it, you know, people would throw all their money at you until they stopped doing it, right? So no, I don't think because you call yourself AI, and I think it's vastly abused already, people that are not really using AI, but doing some machine learning and pattern recognition, you know, everybody wants to brand that AI, right? And it's a little bit like everybody wants to talk about the metaverse because for a period the money wanted to flow in that direction. I genuinely believe that blockchain is a transformative technology, not so much because I want to invent completely revolutionary, super disruptive things, but because everybody is dealing with data, and I find it very hard to see a data case where if you want more secure data, you want immutable data, you want structured data, where blockchain couldn't add some form of value, right? So I do believe a lot in that, but there are other industries, where I sort of mostly invest through funds because I don't know enough about them. But the medtech industry, for me, is kind of a no-brainer that everybody wants to get older and they don't want to be sick the last 10 years of their life. So a lot of breakthroughs in the med sector clearly also has a lot of legs. There's a lot in the food industry. I actually just visited a large vertical farm outside of Copenhagen earlier today, and new ways of producing food in a more controlled manner, in actually a healthier, more nutritious manner. I think food tech for me is very interesting as well. But for me personally, I like food tech. I like blockchain. I like AI, but I think we're in a really wild sort of hypey phase now, where many people are claiming things that have nothing really substantial behind them, and will probably be overrun by other people with better ideas inside months. So while I believe, of course, a lot in the sector, I think you've got to be really careful there at the moment. I actually do believe a lot in metaverse, although that's not flavor of the month anymore. I do think we'll spend a lot more time in virtual environments because there's so much opportunity there for giving different experiences and add some color to our lives and make a lot of commercial processes also more efficient. So there are many opportunities out there, but there are a lot of frogs you have to kiss before you find the princess, in all industries.
Yeah, just one more follow-up on that. So you're a believer in the metaverse. What do you mean? Everyone has a different definition of a metaverse. I talked to 10 different people. I get 10 different definitions. What is your definition? One could argue we're virtually interacting with each other right now, but you have a different vision.
No, I fully agree with you because metaverse is a very diffuse thing, and actually, in any sense of the word, we had metaverses a long time ago. You could easily argue that most games are metaverses, or even The Sims were metaverses, right? So I agree with you. It's a very diffuse category. What I'm saying is that it is for me quite clear that as technology improves, the experience you can get in digital environments will continuously improve, probably to the point will be more or less, if not 100%, lifelike, if you want to compare it to the real world, whatever that will be in 50 years' time, right? Because I think there's a lot of integrations. But the long and the short is that I think virtual reality, augmented reality, metaverses, virtual environments have so much potential that we are all going to be spending a lot more time in them. I don't even want to put a time frame, but in the future, I think a lot of this world will actually be happening in virtual environments. And why not? Because they give so much ease, right? You could argue that our conversation is happening in some kind of virtual space now, because 200 years ago, I would have had to take a ship to you or you to me in order to sit in front of you. And now we sit in a digital environment where it's kind of close to sitting in front of you, right? And all those things will just keep developing, and obviously it gives a lot of ease of use to interact with other people, but also entirely different experiences. If you could go on a summer holiday to Mars and experience that as if you were actually there, I think there'll be a market for that. Or you could be something you'd rather be occasionally than yourself. I think there'll be a market for that. You could participate in your favorite sports by being on the field and being one of the players. I think a lot of people will participate in that. So I'm just saying that whole thing, call it metaverse or call it digital reality, I think is an interesting investment case. But again, a lot of pretty harebrained ideas and long between the ones that have traction and probably we haven't seen the real winners in those spaces yet. They probably haven't been created yet, because there's also a technological progress that is needed, right?
Well, Lars, fascinating conversation. Definitely worth going on a ship to talk to you in person if that were an option. So thank you for your time and being here virtually with us today. Where can people learn more about you, the Concordium Foundation, and the current projects that you're working on?
I would say the easiest thing is to go to concordium.com, where that will then lead you to all sorts of other channels if you're more interested. But there's a basic introduction to what we're doing. Not so basic, really. I mean, quite in depth also of the whole science and technology behind it. But that would be a good place to start. And then from there, you can move into all the various channels where we also entertain and interact with our communities.
Excellent. We'll put a link down in the description below, so check out that website. Thank you very much, Lars. Speak to you again soon.
Thank you. Take care. Bye-bye.
And thank you. Thank you for watching. Don't forget to subscribe.